we got a lot to cover today. You ready to get going? We talked about, last time we talked about some scenarios of some good trustee investments. And today I think we're gonna talk about, I don't think about it, we're gonna talk about maximizing returns on trustee investments. Another thing that I checked into on that matter with regard to that was, what did you ask me? You asked me about um, investing when you're not an accredited investor. Remember that question?
I remember asking, I don't remember what the question was. I think it was,
We talked about it.
what's the difference on your end with working with accredited or non-accredited investors?
And then I sent you the form to show you that what I had to fill out and turn into the state. Remember that form?
Yeah, I couldn't pull it up again
It's
because it was
okay.
in the
I
chat,
just
but
I asked the large language models, I asked them if they, what was the, if you're not accredited, what's available, for you to invest in.
really limited.
It is pretty limited.
It makes sense to me. Obviously, the more money you have, the more opportunities there are. I was just wondering, because usually I see people with, it's usually with some type of a crowdfunding thing. And I assume that it was more paperwork or maybe more liability or something on whoever the operator is. I was just
Mhm.
wondering.
Yeah, the person who's putting it together, the syndication.
Yeah.
Yeah, and depends. Those are all different. They're all over the place too. So you could have a syndication where they give you a participation, not only in the interest, but what you're hoping to find if you're looking into those kinds of deals is something that returns you. Let's say it's on real estate, not on a note, but let's say it's on real estate. You want to get that depreciation passed through to you, and the passive income, and get the depreciation write off. So that's something we're going to go into a little bit today about the notes and try to maximize your profits. So that's kind of our focus today, is maximizing your returns. Can you see in the chat box a link that I put up, or is it only show you if you're here in the room already?
I don't see anything in the chat box right
Oh,
now.
let me put it in there again. So this is a link to my notes for today. So this is everything we're going to talk about. So that's there for you. And so we'll go through that. So today we're going to work on maximizing returns on your trustee investments. And we talked about those real world scenarios last time. And so we're going to look at some strategies to enhance our returns and cover some reinvesting earnings, tax advantages, refinancing, selling notes, and some practical exercises. So that's what we're going to do today. So one of the first things is, which was interesting to me, is the topic is reinvesting your earnings. Using compounding to maximize your returns. And so that's kind of one of the kind of basic, you know, investing 101 ideas is, when you earn interest, leave it in there, and have your interest earn interest on, on its interest, so that it grows faster. So for example, if you put in 10,000 bucks at 8%, and you withdrew your earnings every year, at the end of 10 years, you would have your initial 10,000 investment and then $8,000 more. But if you used a reinvesting strategy and you invested your profits every year, at the end of 10 years on a $10,000 investment, you'd have $21,589. So by compounding your investments, you get an additional gain in that particular scenario of $3,589 extra by leaving the interest in there and letting it compound on itself, interest on interest. Does that make sense? Yeah, so most everybody knows about that. That's a pretty basic one. So there's different methods of reinvestment. And so let's talk about those for a minute. So you can do what's called a rollover return. So let's say your investment pays off and then you reinvest into a new trust deed opportunity. There's three ways to do that. Direct investment is just without any leverage. So you receive $50,000 from a note payoff and you directly reinvest the $50,000 into a new trust deed. Your returns will be based solely on your $50,000 investment, right? Common sense. Another strategy, which I haven't seen done, and I'm not sure that it makes a whole bunch of sense, but I've heard about it, is using leverage through a loan. So you get your $50,000 back and you go borrow another $50,000. Let's say it's at 8% or 7%, and you loan the 100 total out at 10%. You've got a little spread that you're making on your 50,000 that you borrowed, plus you're making the amount on the 50. So that's a leverage strategy. I think some people call that now, I think the kids are calling it arbitrage, where you're using other people's assets to get a spread between the two and make some extra money. And then the third way of doing a reinvestment would be through a partnership or syndication, which we were just talking about, where you either pool your money with other investors and you earn prorated investments in relationship to your investment. Usually, if somebody wanted to make money on, let's say you put up 50,000 and you had 5 friends put up 50,000, so you have a total of 300,000. You can't do this without a license, but it's a strategy that you can use as a partnership or syndication with the right licensing. You can charge them a rate to manage it. So let's say the rate that you're going to pay them is 8, but the borrower pays you 10. So you take 0.5% for the servicing company, and you keep 1.5% as a yield spread for yourself. So you make a little bit of money, 1.5% on your friend's $250,000. So that's another way to invest. And that's what brokers do. We take a little piece of other people's money for managing it. So, but yeah, you typically cannot earn returns on other people's money unless you're borrowing it and to make repayment, or you're managing a fund or investment pool and earning a fee or a profit split. And with those, you have to have licenses or documentation. So another thing that you want to kind of watch out for, or want to make sure to maximize your returns, is some diversification strategies. Did you have any other questions on other thing before I move on?
No, but what the arbitrage that you were talking about, is
Yeah,
that
arbitrage. Yeah,
that that seems a little bit more risky, but maybe not.
it can be. It can be. That's why I've never heard of it much. I mean, I've heard of it, but I've never ever watched somebody do it or been around anybody who played that, other than the brokers themselves, who are, we have the borrower and we have the lender, and we're putting everybody together, and we do it that way. But borrowing money to do it, I've seen it, heard about it, but I haven't done it. Seems super sketchy because if a borrower doesn't pay, then you have to make that payment. Are you prepared to make the payment on the loan? In addition to what you're doing in your life right now, if you borrowed that money, because you can't stop paying, right? You have to make it. So yeah, it's super risky. So that I don't know that that's a great idea. I wouldn't, as a in a conservative place, I wouldn't do that. But it depends. I mean, if somebody's handing me money at 4%, it's essentially what the banks do. They borrow from the Federal Reserve at 4%, 5%. You'll see the Fed rate, and then you go down to the bank and you want to borrow money, and it's 7. That spread is what they're getting. So it's done through a lot of different companies do it that way. But I think it's hard to do as an individual. And like I said, I haven't seen it done, but I've heard people talk about it. I think they were kind of people who talked about a lot of baloney type stuff. They didn't always, you know, didn't always tell the truth, or
I
they
mean,
exaggerated.
if the banks are doing it, then I guess it makes sense. You just have to be really smart about it.
Well, and look at what the banks make you do to get their money, to get them in that position. They're very, very uh, picky and thorough. And usually, what they do, they even do something else entirely different. There are some community banks that will hold the money locally and invest in the region, or little regional banks. But a lot of the home loans and that kind of stuff, those are automatically sold off as soon as they're funded. They sell it into the secondary market and get all their money back. So they'll make a yield spread premium for buying a note or creating a note, selling the note. They'll make a premium on it, and then they'll also, if they keep the servicing, they'll collect uh, money for servicing the note during the time. A lot of times they don't do it though. The smaller banks just sell it off. Some of the bigger ones like Wells Fargo and those guys, they have their own servicing departments. That's interesting. Um, so let's go into diversification. So diversification, kind of easy thing to understand. You want to spread your investments across different types of assets, markets, durations to reduce your risk and improve the stability of your returns. So, in the context of trust deed investing, diversification helps to protect against losses if one investment underperforms or experiences delays. So, let's break down those parts. So, diversifying could be by property type. So, you could do residential notes secured by single family homes, multifamily properties, or rental properties. You can do commercial notes backed by commercial real estate, such as office buildings, retail spaces, or industrial properties. Or thirdly, you can do land notes, which the investments are secured by undeveloped land or lots, often with the potential for development or appreciation. So the example of that is, let's say you have 300 grand to invest, you do 100 grand in each one of those categories. Maybe your residential trust deed is 12 months, your commercial trust deed is 24 months, and your land development note is a 36-month term. So you've got yourself spread out in type, time, and hopefully there's some other things we'll go into here in a minute. So investing by duration, that kind of those last three gave duration. So the short-term notes typically involve bridge loans or construction loans with 6 to 12 months timeline. These offer quicker returns and liquidity. And then the longer-term notes involve stable rental properties or commercial investments with terms of 2 to 5 years, providing consistent cash flow. So it's pretty common in commercial properties for them to have a 2 to 5 year balloon on their mortgages. You wouldn't think so, but it's really common. Are you familiar with that?
A balloon payment?
Yeah. The banks will only loan them for up to 5 years. 2 to 5 years is as long as they get 24 months, they borrow the money. And then they've got to renegotiate their loan. So it's in commercial notes.
With the same bank or with a different lender?
It's usually with the same bank. They just renegotiate it. So what happens with commercial is it's more volatile. So the banks want to be more protected. So as trusted investors, so would we. So we want a shorter term, or if we use that amount of time for that kind of note, we don't ever want to go past 5 years. There are some out there that are government backed that go to 10 and 15 years, but we're too small to take that kind of a hit and that kind of a time frame. So within 2 to 5 years, like in the last, we had pretty stable rates for a long time, from 2008 until, a couple of years ago. Um, but that's not normal. I'm used to seeing, in my lifetime, I'm used to seeing things right around 6 to 9 years. The rates go up and down pretty good every 6 to 9 years. So by doing it in 2 to 5 years, you're able to reset your interest so that you're always at market, so you're not, under being underpaid. And that's what we're trying to do, is maximize our returns here. So nothing hurts worse than to have a loan out at 4% and the market's at 10, and you can't get the loan called off, paid, and get your money back and get into 10% money. So nothing's worse than that. So hey, it's okay. Whoever it is, they're not breaking in. And then of course with the construction loans, we only want those, or the bridge loans. Those are only going to be 6 to 12 months anyway. I mean, those are nice and short. Another way to mitigate your risk is to by geographic location. So you want to do across different regions or markets to mitigate, the impact of local economic downturns. Even today we're seeing uh, the talk is, you follow the U-Haul trucks report. Where are people moving to? And where are they moving away from? And so that's a big deal. Where people are moving to is where you want to invest your money. You don't want to find a spot where they're moving away from, to protect yourself. And that's one of the diversification things that works really good. So why does this diversification work? Well, it's a form of risk management. So if one of the investment faces delays or defaults, the others continue to generate returns. And that's, to me, that's kind of what I like to see too. I like I'm interested in multifamily apartments. I'm interested in RV parks and mobile home parks, because you can have 2 or 3 or 4 or 5, 6 people move out. It doesn't affect your investment. So I kind of like having things in multiple pots, or having multiple income streams coming from the properties. Opportunity flexibility. So the different types of investments perform well in different market conditions. So what that's going to do is, you're going to learn, if you do this, do different opportunities in different markets and different diversification, you're going to learn how to pick better markets, and how to, over time, you're going to get better at choosing which places you want to put your money in, and under what conditions those, makes it good sense for you to invest in that one area. For instance, residential markets might be strong even if commercial real estate slows down. And the cash flow balance, short-term investments provide quick liquidity, while the long-term investments build wealth steadily. So there's another thing that is important in this diversification is timing considerations. So evaluating market conditions. This involves assessing the current real estate market and the economic environment to determine the optimal timing for reinvesting in trust deed opportunities. A well-timed investment can significantly enhance the returns and reduce the risk. So the obvious question is, when's the best time to reinvest, right? So good indicators would be uh, when borrowing costs are low, it can create some opportunities for some higher margin trust deed investments. Like for example, we are looking at a lack of housing inventory, and the interest rates are higher now. And there's a push to lower those interest rates. If they get lowered, there's going to be a building boom. And in the building boom, there's going to be a need for short-term money from private notes. And so that'll be an opportunity to grab 8 to 10 to 12% on construction loan money with your investments. And those will be, usually in a growing market because that's where they're going to build. And, it's a newer property, so the collateral's nice. You're not going to have any problems for 5 years or whatever, but, it's just a good deal. When there's high demand for real estate, if the market's really strong, especially in growing regions, this often means that it's safer and potentially higher returns are available on trust deeds. And like everything, higher demand, higher price. Another thing that you want to look for is the stability of the market. Look for a stable or appreciating markets where the values support the security of the note. So you don't want to buy, like in Florida, the last 12 months, the prices have just tanked on houses in Florida. They've just gone.
Really?
But, sorry?
Really? Why?
Well, because the interest rates went up and they have everybody moved there. And so when everybody was moving there from the COVID thing, the prices went above what they should have gone, and everybody bought in, and they bought in at higher rates than they should have. And now when they want to sell, they can't get anybody to buy it. The prices have come down. The demand is not there anymore. So that market is getting crushed. So you have to be really careful if you're going to invest in Florida right now with the values. So look for stability in the market. See if it's people moving in or moving out. People were moving in, and that was great to get in, short term. You wouldn't want to do long term there. And all of the stuff that we do, at least that I do, I'm interested in the short term. There are people out there that, they want to put their money in somebody's property and they just want to receive the payments every month for 30 years. I don't know if that's you, but
That kind of was me. That's why I wanted to do the residential notes,
yeah,
because
30
you
years
just
without a,
do one, like, research due diligence one time, and if it's good, then you don't have to keep doing it every 2-3 years. So that's one mindset that
yeah.
I have, but
Did
there's
I?
also downsides for that too.
Yeah. And there's nothing wrong with that. Did I blow your mind when I told you that the average person moves in 8 years? I told you that. I remember telling you that. So with this idea, if you're going to go for the 30-year, but the average person moves in 8, it's possible that you get somebody who pays the full 30, but it's also possible that they move out in 8 years and you've got to replace your money somewhere else. So that's something to look at. Check the averages, how long the average person stays in the home. And then there might be some indicators out there that might indicate that someone would stay longer. Let's say they were born in the community. They went to high school there, graduated there, went to the community college there. That person might be someone who hangs out. it seems like to me, a lot of the people that I went through high school and college with are no longer in the hometown. I'm not. So everybody kind of moves around a little bit, I guess, looking for their jobs. Um, I guess the next thing we were talking about stability, and we went into Florida about buyer and seller market cycles. When it's a buyer's market, property prices are low, and you can secure trust deeds with strong equity cushions. So if the prices are low, why would it have an equity cushion? They're likely to appreciate, right? So that gives you more equity as they go up in value. You're not raising your loan, so you're getting a bigger equity cushion. In the seller market, potential higher returns are if the borrower is leveraging increased property values. What in the heck does that mean? Potentially higher returns if the borrower is leveraging increased property values. Seller's market. Oh, I see. They're taking their money out and leveraging up to another unit, and they want to borrow some additional funds, maybe a bridge loan or something like that. All right, so how to analyze the market cycles, understanding the market phases. So there's expansion, peak, contraction, and recovery, right? Every cycle does that, right? Expansion, peak, contraction, recovery, over and over and over. So increasing property values, strong demand, and good opportunities for new trusted investments are on the expansion, the upward rise. The peak, the high prices, are the high prices, but caution is needed as a market correction may follow. Now, right now, what you're seeing in the stock market is who's our favorite stock market guy? He's put all his money on the sidelines. Why does his name slip me right now? Um, the fellow from Omaha, Nebraska. He's got billions of dollars on the sidelines, and several other investors have taken their money out of the stock market. I think they're thinking that we're at a peak. A contraction is the falling property values, and there's a reduced demand, posing a higher risk for trustee investments. So as the property values are going down, if you have a note secured by a deed of trust, your equity is shrinking, your protection is shrinking when values are going down. So contraction, a market that's contracting is not somewhere you want to put your money. So we want to make sure we understand those markets. In the recovery stage, the prices are stabilizing and they begin to rise. And that is an opportunity to reinvest, but you should be cautious because it's hard to see the bottom until you're off of it a bit. So be careful for that. Property values and trends. There are some key metrics to evaluate here. One of them is property values and trends. And the tools that you can use that are available to the public are Zillow, Redfin, or MLS data. So you can track appreciation and depreciation trends. You can get rental market data if you're investing in notes backed by rental properties that ensure rent prices are stable or rising. You can usually get that through property managers. And I think there's some other companies out there that provide that data. Um, what is it? Rentometer? Heard of Rentometer? Yeah. That should have some. They have a lot of data on that site. I think you have to pay for a membership to get at some of that. Look at economic indicators. Look at local, excuse me, local employment rates, population growth, and economic development. So, if the employment rates are high, population is not growing, and there's no new businesses coming to the area, probably a no, right? But if it's the opposite, there's hardly They can't get enough people there to work. The jobs, like people commute around the country. Well, there's jobs in Houston. Everybody takes off for Houston, right? So if they're looking for people, population growth, and the oil boom's going or whatever's going, like in Austin, they're going crazy with the SpaceX thing. And then another thing that you can check into is real estate transaction volume. So a high volume of sales often indicates a healthy market. So where are sales right now in California? Do you know?
Mm.
So they're off a bit. They're up for the season, but they're off of last year's numbers right now. So we're down a little bit. I think it's 3.6% off of last year's new houses for sale. So the volume's decreased year over year. So that's something to watch for. Now that's statewide. If you go into specific markets, it changes for each market. So you could pick, I don't know. I don't know of anywhere that's growing crazy. Well, I do. So Folsom, California, or Roseville, California, they're growing bananas right now. So those two cities would be a good place where there's a high volume in sales and a healthy market. But other parts in California are not so much. Let's see here. Let's talk about a practical example. So you get 50,000 from a note payoff. It's the residential market in your area is peaking, but the commercial market is in recovery. Instead of reinvesting in high-priced residential notes, you find an opportunity in a commercial trust deed offering higher yields with relative risk, lower relative risk. So this is our example. You can check this commercial property, get market reports from CoreLogic, CBRE, or the National Association of Realtors. You can get some local market insights and network with local real estate professionals that are commercial brokers. You can do an economic evaluation by monitoring federal or local economic reports and trends that might impact real estate values. So if this is the case, 50 grand, and the residential market is peaking, I think that's going to push you towards commercial. And it looks like they're they're at the lower end of the relative risk. So what did it say? Oh, they're in recovery mode. So that means they're on the way up, right? So that'd be the place to put your money because you're going to have appreciation in that particular scenario. So here's the key takeaway. It says the best time to invest is when the market conditions align with your investment goals and risk tolerance. Yeah, that makes sense. Evaluating market cycles helps you avoid overpaying for deals and positions you to take advantage of opportunities when the market is in a favorable phase. Do you think after today you kind of have a little bit more of an idea of the market phase and how to find yourself the best deal for what you're looking for? We kind of talked about that. You feel a little better about that?
Good. I feel like I'm just learning about commercial, so commercial is still kind of new to me.
Oh, that makes sense.
Yeah.
Oh, that makes sense. Yeah, it's a little bit different of an animal, but it's also, to me, it's much more comforting because it doesn't have. Are you familiar with who is that? Ben Shapiro? Do you know who Ben Shapiro is from LA?
Hmm.
He says feelings
He's
don't.
not. He's not in LA anymore.
Well, where he's in Florida now, right? Or Texas, somewhere he's gone.
I
But
think Tennessee or something.
yeah, he's but he says the facts don't care about your feelings.
Yeah.
Well, that's, to me, that's kind of the gist of it. Like, there's more feelings in the residential market, and the commercial market, it's just math. These are the numbers. This is net operating income. This is what it's worth. If it's a mom and pop operation, it's not going to have a good cap rate. as if it's a, one where you can do an investor hands off. So kind of that kind of a deal. All right, so you're ready for tax advantages?
Yeah.
Let's talk about that. So one of the key advantages of investing in trustees is the potential for favorable tax treatment. So understanding how these benefits can enhance your overall returns and reduce your tax liability. So the passive income treatment, are you familiar with that?
What was it?
The passive income treatment. So interest payments from trustees are typically considered passive income. So passive income avoids self-employment taxes. It saves you 15.3% on your income. So if you do a construction, let's say you buy a lot and build a building, you're doing not a passive income, you're actively involved in that income. So you have self-employment tax on it of 15.3%. So that goes away with investing in trustees. So you don't get that tax. Passive income can also be offset by passive losses, such as depreciation from other real estate investments, including which reduces your taxable income. So this is what we kind of touched on when we first started talking today, was this depreciation and investing in other real estate investments. And the trick for this is they both have to be passive income and passive losses. It can't be active income. You can't go and buy a rental and take your depreciation from a rental that you operate and collect the rent and take a deduction for your depreciation off your passive income from your notes. You can't mix those two. It's passive income, passive depreciation, active income, active depreciation. Does that make sense?
Kind of. I need a new tax person, so.
Okay. So with your taxes, if you there's okay, but well, let's break that down a little bit. Let's go behind the scenes a little bit like that. So if you're working as an employee, you are being paid a salary, right? A wage. So the person working as an employee has the highest taxes of all the people. So an employee gets the FUTA tax, Social Security tax, all these different taxes. Employer matches the taxes. They get the worst deductions. They get the worst everything, right? They have just a flat deduction now. They try to itemize it. It's rotten. It's the worst tax bracket of all. That's active income as a wage earner. The next choice is, let's say you want to be self-employed. You want to run your own business. So now you're going to have a self-employment tax that's 15.3% plus 15.3% because you have to put up your taxes for the government, the FUTA and Social Security, those taxes, and then you've got to deal with all that. So they're the next highest tax group, but there's some benefits for them by being self-employed and creating a job for themselves or possibly for others. They get to pay taxes after expenses, where the first group on salary, they can't invest, they can't take any of their money and deduct any expenses from their income. Maybe there's a little things like, but it's never enough to, it seems like it might be in some of the higher income brackets, but the straight deduction is always seems to be more than what you can write off for a salaried person. And the benefit of self-employed is, let's say they run their business and they need gas to run their business and they need electricity and they need phones, and so all those expenses come off of their income. So if they make $100,000, you deduct all those things, they have $50,000 left. So their taxes are based on their profit that's left over, and they pay that. The next group is business owners, people who own the business, but they passively operate the business. They, as a matter of being passive, they pay even less tax. They don't have this self-employment tax. And then the final category is people like investing in trust deeds. That's completely passive. So you get the least amount of tax against you for investing passively. Why is that? Why is it kind of laid out this way? Well, the government wants those who save and who have money to invest that money back into society, so they give them the best deal. And that's why it's broke down that way. You'll hear on the TV all the time, they say, so and so doesn't pay any income taxes. Well, there's only one category that pays, or two categories actually, that pay an income tax. The salaried worker and the self-employed, that's a small business. The bigger corporations and stuff, they don't have an income. They have a corporate income tax, but the person who owns it just passively owns the shares. They have a passive tax. It's not an income tax. So you can use the nomenclature, the words, to say that they don't pay income tax. Well, that's true because the tax law doesn't ask them to. It asks them to pay, capital gains tax. So it's always interesting to me that people say these things and they're completely different animals, and they take people's lack of knowledge and throw that out there and make it look like the rich people are not paying anything, but they are.